Bloomberg Audio Studios. Podcasts, radio, news.
This is the Bloomberg Daybreak Asia podcast. I'm Doug Krisner. You can join Brian Curtis and myself for the stories making news and moving markets in the APAC region. You can subscribe to the show anywhere you get your podcast and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.
Joining us now in our studios in Hong Kong for a little bit more on U.S.-China relations is John Liu, Bloomberg executive editor in Beijing. John, thanks very much for coming into the studios with us. So just as an overview here for the audience, how would you characterize U.S.-China relations at the moment? Waxing or waning?
I think I would call them stable. But I think given how much tension there is, how many issues that exist between the two countries, I would say there's always the danger things will get worse. And I would say that the opportunity to improve ties is a very, very narrow window. And with the election in the U.S. coming up, I would say pretty difficult to see a massive improvement anytime soon. John,
you and I have talked about the issue of overcapacity in the past. This is not only an issue that the U.S. has raised, but the European Union has been very vocal about this as well. Is this being taken seriously on the part of Beijing, or do authorities in China basically feel the only way that they can recover from this economic malaise, this slump, is to export the country's way out of this through cheaper goods? Is that really the line that the government in China is taking?
I think that the government in China sees how important exports, how important a role exports have to play if the country wants the economy to revive and for growth to go back to something more in the, to be in the 5% range, which they've made their target for 2024. Beijing is not going to agree about the description about overcapacity, but I think there is a growing recognition that exports may not be the way to go about it, and that trying to put too much emphasis on exports is actually going to cause more trouble than it's worth.
I think what you said right off the bat, that things are sort of moving sideways almost in U.S. relations, not particularly good or bad. It makes a lot of sense. It seems like the vitriol has dropped out of the language. You haven't seen a lot of hyperbole here. And also the Taiwan story, I mean, it's still there. There's no question about it. But it seems like the temperature's been turned down a little. Do you agree?
I think the sideways description is apt. In terms of Taiwan, I think, with the inauguration of Lai Ching-te as president earlier last month, that reaction was relatively strong. And I think you will see Beijing take a pretty hard stance when it comes to anything they feel like is an attempt to move the island towards independence. So there is still a lot of risk there, I would say. I don't think that situation has calmed substantially.
Well, the past 10 days has been sort of without a lot of serious jawboning, don't you think?
There was something really interesting happened yesterday, which was Prime Minister Modi in India received on X a congratulatory message from Lai Ching-te, the president of Taiwan, and Mr. Modi responded by saying he hoped that there could be an increased relationship between Taiwan and India when it comes to trade and technology, and Beijing acted very quickly to condemn those comments by Mr. Modi. We have to wait and see if that becomes bigger or smaller or goes away, but I think the sensitivity remains. Yeah.
So you described the situation between China and the U.S. as kind of moving sideways right now. Let's call it just a drift. I'm curious, is some of that due, or a large part of it due, to the fact that we've got an election in November and it's unclear at this point who Beijing will have to do business with in early 2025?
I think the main motivation for Beijing right now is economics, and Beijing needs to keep its access to markets in the U.S. and Europe, just because of what we talked about before, the importance of exports for economic recovery domestically. The other issue is China needs foreign direct investment. They're hoping that multinationals, be it Tesla or Apple or, the various American companies who do lots of business in China needs them not only to maintain their level of participation in the Chinese economy, but hopefully to put even more money into China. And so trying to keep a lid on U.S.-China tensions helps them do that.
I'm imagining that would be pretty difficult under a Trump administration to hope for more foreign direct investment from the U.S. Am I wrong on that?
I think most people in Beijing would agree with you on that, especially given the rhetoric from Mr. Trump in the campaign, talking about 60% tariffs across the board and tariffing Chinese companies who've manufacturing in Mexico. I think that is a real concern for the Chinese government. And I think if there was a Trump administration that came into power in January of next year, that the relationship would get pretty rocky, at least at the start.
In some other areas of our coverage, we mentioned that the South China Morning Post has a story today saying that for immigrants in China, there's a real fear of missing out. There's kind of a rush to move overseas now. It's either now or never, saying that the middle class with the means to move abroad see the window kind of closing as countries tighten immigration policies. I wouldn't imagine that these are massive numbers, but it's kind of an interesting side area of coverage.
I think the disparity between economic performance that we've seen in the United States especially and what we've seen in China has been motivational for people thinking about immigrating to the U.S. and overseas. So
more the slowing economy than political.
Yeah, I think it's a combination of everything, right? I think if the economy was growing at some tremendous rate, I think people would be more overlooking the political situation might be more appetizing or amendable for people. But the fact that the economy is bad, there's less opportunity, and the political situation is difficult, I think that's a double whammy.
Is the government feeling greater urgency now, given the kind of the stagnation that we're seeing economically, to really kind of put some of the policies that have been debated, that have been talked about, put much more of that to work?
So I think there is a real recognition in Beijing that the economy needs support. There's no doubt about that. You've seen that with the money the central bank is providing for local governments to buy empty apartments, all of the fiscal measures that China has taken. But at the same time, I think the Chinese leadership also prioritizes national security. And there is a real concern that, the United States is trying to contain China, taking actions to undermine China's development. And so there's a real worry in Beijing about how secure Beijing is and its ability to project power, especially when it comes to Taiwan. And so these things are sometimes in conflict with one another. And I think that's what you see, both trying to achieve economic growth, but also trying to achieve these national security aims, and those two running into each other at times.
In terms of the stimulus and trying to rescue the economy, do you still see not very much likelihood of one fell swoop, a sort of shock and awe move? Do you think it'll continue to be incremental?
I think incremental is by default the way the Chinese government goes about almost everything. I think you have seen the magnitude of the response being ratcheted up very steadily and continuously. I think what Beijing is doing in terms of real estate, taking central bank money to effectively provide demand for empty apartments, that is something I think would have been unthinkable a few years ago. I think if the economy needs more support, we will get more support from Beijing. It'll just come very slowly.
Yeah. All right, John, thanks very much. John Liu joining us, Bloomberg executive editor in Beijing. China's exports will probably jump in May, posting some pretty broad gains. I'm Brian Curtis along with Doug Krisner. We bring in James Mayger, Bloomberg senior China reporter, who eats this stuff for breakfast. James, it's very seldom that we see such a big gap between what the consensus estimates are in a Bloomberg survey and what Bloomberg Economics is estimating. But they've got double digits here, gains at 12.1%, the consensus 5.7%. What sort of accounts for the discrepancy?
I think the Bloomberg Economics folks are expecting part of that. The difference there is to be sort of base effects. There was a drop last year in May, and so they're expecting a real pullback from that, a real expansion from that. They're also sort of really focusing on the strength we've seen recently in other exporters in Asia, South Korean exports, Taiwanese exports. There's been really strong demand for chip exports from those two places, and the Bloomberg Economics expects that that's also going to pull along exports from China. One other thing to be looking at also is how much sort of exports from China of steel and excavators and other things, which are not being used in the housing sector, which is still struggling domestically, and that's it's what that sort of weakness in China is underpinning that strength in demand, strength in exports, because Chinese companies are basically having to sell overseas instead of being able to sell domestically. So I think those are the kind of factors that everyone's expecting to really drive a good number in May.
Is this a type of industrial policy, do you think, that Beijing is favoring, to be more reliant, even in the current environment, on the export equation or the export side of the equation rather than trying to fortify domestic demand?
I think the way I look at it is China is trying to drive its dominance of specific sectors, and that is the domestic market is not caught up with the amount of they're able to produce of those things now. So especially on things like batteries and EVs, the government has put a lot of money and a lot of effort and a lot of protectionism into making sure that Chinese companies are able to dominate the Chinese market. And now that is because China isn't able to, the Chinese consumers aren't able to take all of those cars. Some of that is going overseas. I think also part of this is, as I said, is just caused by the housing slump. This is not like a policy that the government did try and pop the housing bubble. They didn't, I think, mean it to become this bad. But this slump has meant that the existing sort of production capacity is now having to flow overseas as well. So it's partly this is industrial policy that the government is driving, and partly it's just the domestic weakness. And as you say, the government is not looking to really stimulate domestic demands to sort of take all of these goods.
Well, if we look at some other data, the Japan manufacturing PMI was pretty positive in the month of May, or at least it was positive, and South Korean exports rose 9% in May. So it does raise this question about external demand. That's probably what most people outside of China really care about. Do we see that external demand as pretty solid, or have to wait and see?
I think both Japan and Korea are benefiting at least somewhat from their weak currencies. So, the yuan and the yen and the won are pretty weak against the dollar right now. And also, as I said, there's been a massive spike in demand for high-end chips. So that's benefiting South Korea as well. So companies like Nvidia and the AI boom in the US is really driving record exports from Korea and also record exports from Taiwan. But there is a broader sort of industrial strength or a broader sort of recovery and trade happening, especially across Asia, and I think that's going to help benefit China as well.
So, James, when you look broadly at the entire country of China, how is economic activity being distributed right now?
I think it's pretty patchy. There are certain places that are doing better, and there are lots of places that are not doing well. It's the places that were more reliant on housing demand and housing construction demand, especially in the years leading up to 2021, that are now not doing as well. Obviously, especially if you look at places like the northeast of China, where you have real like quite deep population falls. Plus, you have it was already pretty weak economic environment up there, and then you add into that this housing slump and housing construction slump. I think those kind of places are really struggling. The places on the eastern seaboard that are more export focused, that have a better, stronger economy, and they're not seeing those kind of deep population declines. I think those places still continue to do better.
You mentioned the base effects will play into this. What about seasonal patterns?
May is generally a good time, like the middle of the year is generally a good time for trade. It's really weak in the first quarter because of the Lunar New Year, and there's a lot of sort of people export a lot more towards the end of the year to get into the Christmas season overseas, and then the first quarter of the year is usually pretty weak. So there should be some kind of rebound that we will see, May, June, July, August, that sort of period. And our reporting with the Canton Fair early this year, which is the biggest export trade fair in the world. So, Chinese companies were saying that they were seeing a better. So we were seeing more demand, we're seeing more orders. So there is being an increase in that. I think the thing to be aware of though is that these numbers are partly being driven by a real slump in Chinese prices. So Chinese export prices are falling. The country's in deflation. This is driving down the value of these exports. So so that's part of the reason why it's strong.
James, thank you. James Mayger, Bloomberg senior China reporter. Lauren Saidel-Baker, economist at ITR Economics. Lauren, it feels like we might be close to an inflection point here on jobs. So we have the jobs report coming. Citigroup's house view is for just 140,000. That's a long way from the 229,000 average that we've seen over the past 11 months. And it's also a long way away from the consensus expectation of 180,000 new jobs. I'm guessing, see what your thoughts are on this. I'm guessing that any number from about 125,000 to 200,000 would be reasonably comfortable for both the Fed and the markets. What say you?
Yes, thank you so much. I agree. It would take a big surprise, either to the upside or to the downside, to materially sway the path that the Fed is on. The labor market has been incredibly tight but cooling. Unless we see a real aberration in this report tomorrow, I do expect that cooling trend to persist. We got a signal earlier this week from the JOLT survey that the number of new job openings has decreased. So while the labor market is still tight, showing some signs of pullback, that's giving the Fed confidence that wage inflation will take us down to toward that target 2% inflation range. I don't expect we need to reach 2% inflation before the Fed makes their rate cuts.
And today's data, when you look at the labor market, was a little on the weak side. Jobless claims up above estimates, and labor cost increased by less than previously reported. So is your expectation here that we're going to get 2 quarter-point rate cuts between now and the end of the year?
Yes, all of the data that we've seen to this point is certainly moving in that direction. Again, the ECB, no surprise, they moved sooner than the Fed. I think September is still a very likely outcome for the first cut from the Federal Reserve. So 50 basis points this year seems to be a pretty mainstream expectation.
Do you think that what happened to the ECB will sort of put the Fed on warning a little bit? This is a little embarrassing because the ECB had all but told markets, it was going to cut by 25 basis points. Then all of a sudden it gets some inflation data that's pretty onerous in a sense, and it even has to raise its inflation targets while it's cutting rates. I mean, that's a little embarrassing, isn't it? The Fed does not want to be put in that position.
No, they do not. I agree completely. But there's also something of an acceptance from these central banks that, again, we don't have to be at 2% inflation. The fact that we've come down so much from our peak inflation levels is showing that easing. And in Europe, especially where they've seen a pullback in real economic outcomes, the ECB didn't want to be waiting for that 2% right before they gave a little bit of stimulative effect to hopefully pull that economy out of recession sooner than later.
And I'm wondering...
Yeah.
Well, whether when you raise an inflation forecast like that there is a little bit of jawboning of the market, that you don't want the market to get too far over its skis in a situation like that when you're entering a cycle of easing.
Absolutely. And I think the Fed has been very careful about that. Chair Powell has been very intentional time after time in saying they will be data dependent, that nothing is set in stone. So that's why we do think September is still on the table, but there is a lot of data to come out between now and then.
So we talked about the wide range of expectations and also that markets and the Fed would probably be comfortable with a fairly broad band there. But if I had to guess between the two on whether or not, good news is good news or, good news is bad news, I would say that the market would prefer to see a well-supported economy here. So maybe a little erring on the upside would be good for the markets. Is that your view as well?
The wrinkle with that analysis at this juncture in the business cycle is that interest rates were so low for so long. The fact that we do have rates persistently higher, as we still do and will very likely over this summer, it's just causing the decision points in a lot of companies' investment mindsets to be different. Now, again, my base case is for 50 basis points of cut this year. That is not going to materially move the needle. If you are a first-time home buyer looking at your mortgage rate, 50 basis points is not make or break. But I do think sentiment-wise, perhaps emotionally, there is something to getting those first rate cuts. But I agree with you. It's a topsy-turvy world where bad news is good news.
Does it surprise you that the yield curve is still inverted, the degree to which it still is? I mean, we've got, 50 basis points in spread between the 2 and the 10?
Yes, that is a bit surprising. We have done the analysis, and typically the inversion in the yield curve does portend a GDP recession, but that likelihood in our analysis was only in the 80, I believe it was about 88% range. So not a foregone conclusion. I do think the consumer with these higher wages, with this tight labor market, is propping up GDP. About 2/3 of GDP is accounted for by consumer spending. So that's why we're seeing a little bit of an abnormal but not unprecedented outcome in that regard.
We've had some fears of late that growth could be falling off pretty rapidly, but it seems like with the 10-year yield at right around 4.30 like that, that's kind of telling you that the bond market, at least at the moment, is not seeing a lot of weakness. Where would we? I mean, would it take something like a 3 handle, maybe 3.75 or so, for people to start really seriously worrying about a fall off in growth?
Sure. A lot of the leading indicators that I'm following are showing signs of life, showing green shoots. Again, I do think it's a 2025 event, so I don't want to be too dogmatic about the timing, but leading indicators showing us that there is rise around the corner. Again, the consumer is the floor to this point of the cycle. That's supporting much more so than the manufacturing sector, the industrial sector. So that broad-based support, even if our sentiment doesn't reflect it, even if we don't always really feel it, our wages are still outpacing inflation. We are still in generally a good position. This is no 2006 where we're over-levered, we have that bad debt and too much of it. So I think our consumer is the thing that's giving these analysts confidence, and to some degree the bond market. That broad-based strength will be felt throughout most industries.
So, Lauren, let's do a little bit of walkabout economics. You're in Manchester, New Hampshire, right? Can you give me a sense of how well the economy is performing there? Anecdotally, what do things look like?
Yes, that's correct. Southern New Hampshire. For context, I'm about an hour north of Boston. Everyone always asks me, is New Hampshire just a province of Vermont? So the economy here, it's a little bit more diversified. We're not just in maple syrup, but we are seeing those signs of stalling. The housing market especially is very tight up here. We nationwide have a lot of shortage rate of underbuilding, so some vacancy and supply issues. We feel that pretty acutely here in New Hampshire with a shortage of affordable housing. But the economy's humming along. People still go out to restaurants as much as we puritanical New Englanders do like to turn in early.
The craft beer is pretty good up in that part of the world too.
Beer is great. Can't recommend it highly enough.
Yeah. Thinking about that here. Pardon me, it's morning time, but still, Lauren, thank you so much for joining us. Lauren Saidel-Baker, economist at ITR Economics.
This has been the Bloomberg Daybreak Asia podcast, bringing you the stories making news and moving markets in the Asia Pacific. Visit the Bloomberg Podcast channel on YouTube to get more episodes of this and other shows from Bloomberg. Subscribe to the podcast on Apple, Spotify, or anywhere else you listen, and always on Bloomberg Radio, the Bloomberg Terminal, and the Bloomberg Business app.